My guest today on StansberryInvestor.com says it's no coincidence that we have record heat, record cold, record number of earthquakes and tectonic shifts. He says it all relates back to what's happening in the financial markets. Joining me today to explain his theory is Greg Weldon of Weldon Financial. It's been a very long time, Greg. Good to see you. Welcome to my new home here at StansberryInvestor.com.
You too, and congratulations. That's certainly a fine home with a great long-standing reputation for what we do, independent research. And kind of what you mentioned is such big picture stuff. It's really sometimes difficult to kind of talk about it in a concise manner. I did a speech back in February of 2020 before COVID hit in the U.S., and it was entitled "The Age of Aquarius," and it was about kind of where we are as a solar system. You talk about NASA just changed the terminology from global warming to solar warming, because it is solar warming. It is tens of thousands of years of cycles of our solar system's orbit through the Milky Way that put us in a place now where there is a tremendous amount of light plasma, cations. They call them this highly ionized positive force field of light energy that is hitting the planet. And what it does is it causes a variety of things to happen. Number one, what they call the Schumann resonance scale measures the geomagnetic electrical force on this planet. In other words, kind of the vibrations, the electrical energy that is on the planet from the ionosphere all the way down to the crust of the planet. Then you have the Gauss readings, which measure the number of atoms in a given space. And what happens there is you have a lower Gauss reading, meaning if you were to take a mason jar and fill it with M&Ms, you shake that mason jar, not much really happens, but you take more than half of those M&Ms out of the mason jar and you shake it, and it becomes a little more violent. And what happens is you have this electrified environment where each end of the spectrum is now vibrating more frequently. This leads to, it's not just record heat, like you mentioned, it's record heat and record cold. It's record drought and record floods. And what it leads to is something like, even in human nature, in brain chemistry, where you talk about the extremism on the left side of the political scale and the extremism on the right side of the political scale. Never has it been more intense at the extremes, and never has the middle been, less, visible as everything gets polarized. You take it to the financial markets where you've had a 50-year credit bubble since they went off the gold standard in 1971. You get the polarization of wealth and income, and you have the setup here where you tie that in, all this volatility and all this kind of seemingly kind of docile chaos is what it really is. And you get to the point where you come to mathematical issues around how much money the Federal Reserve and other central banks around the world have to print each time you go through one of these little down waves. And now the angle of ascent of money growth, the angle of ascent of debt, the angle of ascent of monetization of debt is virtually straight up and down. And that sets up a situation down the road where you're going to have to be really careful, really in touch, and really nimble and flexible with your investments to make sure that you can not only survive, but theoretically great opportunities to be had here as well.
Okay, a lot of good stuff was said right there. I'm happy you brought up the M&M jar, because that's the visual that you showed that stayed with me. And I love how you showed what happens when there's just like one M&M left in the jar to illustrate the volatility. Are we at that point now?
Well, I mean, all you got to really do is I'll give you two quick pointers. I mean, I don't think people realize how severe a drought you have right now in the United States. You're talking about 11 states in the Southwest where 98% of the land in those 11 states is categorized at some degree of drought. In the 48 United States, 48% of the 48 contiguous U.S. states are at some degree of drought. You have a situation in Brazil, too, at the same time, where they have received, it's the lowest rainfall in 90 years for their growing season. Okay, that's since 1931. You start talking about, is inflation transitory? Because that's the big argument now among monetary pundits out there. And you start to you don't really realize you have major droughts in two of the biggest growing areas for certain food commodities, on the planet. And so these kinds of things, again, it's just that it's not that it's one way or the other. It's just more of these things at both ends of the spectrum. And we could talk about inflation, is it transitory or not, for a whole hour. But I would pose the question, are we already seeing signs that maybe employment recovery might be transitory, and that's a bigger issue for the Fed.
Absolutely. So let's talk about that, because you say the Fed is out of bullets now. So to that point, how do you see things?
Well, I would say I hesitate to say they're out of bullets, because the Fed has always and never ceased to amaze in the way that they can creatively print money. And I mentioned in the book that I wrote in 2006, where we predicted a lot of this that's happened then is happening now. That the monetary Armageddon scenario, where it's kind of like in the movies, and you have the general and the guy, they're in the mountain and they have to turn the key simultaneously. There's no reason the Treasury and the Fed can't go in and just vaporize every piece of paper that represents U.S. debt that's ever been printed. Now, of course, that's the day you're going to want to own gold. That's the day a loaf of bread is going to cost you $15. So these kinds of things, the question is, do we get there really quickly, or do we get there in a longer trend? And then, the next big question for me is this really stagflation? Because I don't see inflation as being transitory. And one of the things that's kind of lost in the equation of is inflation transitory is something that I see as a tectonic plate shifting type of psychological shift that not a lot of people talk about. You don't hear it in the pop media at all, where you have transition from the 90s, where you got the internet, you got price discovery became available to everybody, and now it's all about getting the cheapest price. You buy everything on credit, it's now immediately delivered, and everyone's so happy now. You can spend your money and have your stuff right away, and immediate gratification becomes a reality. Versus the last year and a half, where now all of a sudden you have this level of anxiety around supply side disruptions, around bottlenecks, around all the things that happen, where you're not sure you can get the things you want. You have a little more money in the bank, thanks to the central banks around the world, and you can afford to pay a little bit more to secure the supplies of the things you want and need. Where I think now it is a willingness to pay more, an ability to pay more, that is kind of going unnoticed, to the degree that securing supplies to me now more important to the average consumer, making sure even if they have to pay more to get it, where price discovery is not as important as it used to be, and that's huge psychologically.
Absolutely. I totally agree with that. So, Greg, how do you protect yourself in this age of Aquarius, as you say? What are the sectors you like? I know you've been a long time gold bug.
Mm-hmm. Yeah, I mean, we're bullish and bearish on gold depending on how the situation is. I mean, to me, what the Fed, it's interesting how we tie this into the most recent Fed meeting, their minutes, and then the employment report. The Fed has made it very clear. I mean, first of all, you're shy of 70% recovery in payroll employment. I mean, again, headlines. Where is that in the headlines? Let alone all the growth that you lost because you weren't growing. That's maybe another 3.5 million jobs. You have 14.2 million people still receiving some form of unemployment benefits. I mean, you have an entire layer of the labor market, which is basically being vaporized. And it's kind of what I call the hollowing out of the labor market, much like you had the hollowing out of the industrial sector in the US in the 1980s, when Germany and Japan were, taking all our production away. Because really, I mean, the way the bond market is priced right now is, you see kind of the long end's had a rise in yield, and they've taken the inflation risk and run with it. But the short end, and the 2-year note's still below 25 basis points. It's not pricing in any rate hike until the second half of 2023. The Fed funds strip is priced entirely differently. So there's this disconnect even in U.S. fixed income. All right. If you look at long bonds, I mean, essentially, for all intents and purposes, bond markets are worthless. Because if you look at the EU, for example, in particular, still negative yields, it doesn't protect the purchasing power of your money. You invest in your money, you get barely any yield. It's not even fixed income anymore. There's no income to be had. And the money you get back in 5 or 10 years buys you, a percentage of what it used to buy you when you bought the bond or note. So to me, that's a lost investment. My advice to investors is to kind of, you have to be nimble, you have to be flexible. Commodities, I'm a futures guy all the way, more so than a gold bug, because I'm willing to be bearish on gold, and that's kind of the negativity around the gold bugs, is they're never bearish on gold. I'm happy to be bearish on gold, not right now. And I think that longer term, what just happened with the Fed, when they basically said, look, and Powell has been saying this consistently, okay, that the job market is more important. When you talk about especially single mothers out there raising a child and stuff, when you talk about the destruction of those types of jobs and those people that haven't gone back to work being the people that really need to go back to work, this is now the Fed's mantra, and we're willing to acquiesce to higher prices, even if it's a more embedded. All right, they want inflation expectations to be anchored to the upside. They've been very clear about that. So I think that, inflation's here to stay. I think that the Fed is going to allow things to play out differently than they have in the past. They're not going to be preemptive here. They want results orientated, type of policy here. And that's going to require a lot more in the labor market. And the question is, how patient can the Fed be? And then how patient can the market be? And the bigger question is this really stagflation because the labor market is not going to have that growth? And if that's the case, that's going to put the Fed in a real tough spot. It really will.
Interesting. Okay, so getting back to a perfect portfolio right now, gold plays a role, bonds are out. How about cryptocurrencies?
I believe there's some value there because when you take a look at the world, this is the world now too, and worldly pandemic. There's a lot of places in the world where you have access to a handheld device where you can buy crypto commodities, crypto tokens. I never call them currencies because they're not. Okay, but that doesn't mean they don't have value, and they do. And people will flock to them because it's kind of a younger generation type of thing too, where they don't believe in gold. Okay. I mean, I think you have to have both. And I think that you have to be very quick, nimble in terms of potentially getting out of anything crypto because, Fed wrote their white paper on Fed coin in 2014. They have this in their back pocket. They're just waiting. I kind of thought the pandemic might give them the preface to do away with paper money. And I still think that's coming too. And in that case, what do you think the digital currency in the US is going to be? It's not going to be Bitcoin. It's going to be Fed coin. So I think there's danger there, there's landmines there, but for the time being and for the foreseeable future, there's value there because when you get hiccups, there's as many people out there now, if not more, that would be willing to buy Bitcoin and have access to buying Bitcoin that can go in and buy gold. So I like them both. And I will say, I don't like static portfolios here. I think you have to really be very diversified, very nimble. You need commodities, you need, a variety of, in equities, I think you need some Chinese exposure. We haven't even talked about China and the potential for them to derail the dollar is the petrocurrency here. It's big, and it's probably the biggest risk that's out there right now. Imagine a scenario in the US where all of a sudden China says, look, we're only going to accept renminbi for our exports, and we're only going to pay you renminbi for our imports and all the natural resources that we import from you. And they have all the, already all the investment done, already opening some of the trade lines. They're already moving in for crying out loud into Afghanistan. We're barely out a couple of weeks, and already they're building roads between Pakistan and Afghanistan and looking to extend out their sphere of influence. Very smart and very ruthless. And I think you really have to be careful about that in terms of the US dollar and how this could really wreak havoc on the stock market in the US and the economy down the road.
Interesting. Like when you say down the road, how far down a scenario is that?
That's a great question. That's the one we really can't answer because what I have found in my career, as I'm now like ancient, as you can see, right, that things don't happen as fast as I think they will. Okay. And the central banks and their ability to kind of kick the can down the road has never ceased to amaze me in my career. Having said that, what makes this so exciting to do and why I still have so much passion for what I do is it could happen tomorrow, So that in itself is the polarization that we're talking about. It's in everything, even that, in the sense that this could go on for another 20 to 25 to 30 years, or you could have some, landmine touched off next week. And I think it really, the Chinese right now pose the biggest threat, and it's a currency threat specifically.
To the US dollar,
Absolutely.
To debunk the US dollar as the reserve currency
Big
of the
time.
world.
I mean, they have a Chinese, they trade Dubai crude oil in a Shanghai futures contract now. And you have the Russians now talking about, hey, we're going to benchmark our oil off of that. I know that Biden, when he came in, he kind of dissed some of the younger guard in the House of Saud, and you have some movement there, even where they've shifted some cargoes to China. Yes, we're importing less oil, but we still import oil, and let's not forget that. And I think that's something that people tend to overlook, that we import oil, every day. So some of those cargoes that were meant for the U.S. were shifted by the Saudis to China. So I don't know. I mean, the U.S. can only push their advantage so far until someone pushes back, and now China's in position to do that. And that recently there's been all kinds of military, games going on between Vietnam and between the Philippines, who actually threatened China in a big way recently around artificial islands, around airspace, infringement, particularly as it relates to Taiwan. Recent comments as it relates to Taiwan too from the the Communist Party in China. I mean, to me, that's something that really poses the biggest immediate threat to the financial markets here in the United States.
And just to bring it back home, you saw the news item of Wells Fargo shutting down personal lines of credit, um, and shutting down people from existing ones, basically messing with people's credit scores, Greg, which has a lot of people wondering if this is the beginning of the end on the commercial banking side. A lot of guests I've had on are saying that the U.S. economy is on the edge here.
Yeah, well, I mean, I think that when you look at the markets, a lot of positive things have been priced into this, particularly the stock market. I just did a piece today talking about the consumer as it relates to the labor market. All right, I mean, even initial claims have kind of gotten sticky at 370. I mean, that's 40 to 70% higher than it was consistently before the pandemic. So this, you have the labor market, which is the big concern as it relates to the Fed and inflation. And is it transitory? And I don't think inflation is as transitory as people make it out to be. And you have China. So you have to be nimble. You have to be quick. I almost feel like, the best way right now to go about it is to be your own trader, kind of, replicate your own CTA almost, because the futures market offer you liquidity, the opportunity to be long and short just about anything. And it offers the diversity and flexibility and nimbleness that you need, I think, to, again, thrive and not just survive.
Let's just bring it home to gold, Greg, because that's how we met. So when you say you're bullish gold right now, did that bullishness start last August when we hit the nominal high? And do you think we'll re-see that high, or what's your forecast here?
We really started getting bullish on gold actually, and originally, of course, in late 2015, you had the first wave, but on this latest wave, August of 2018 was huge for me because Jerome Powell came out and said, we're going to reflate and we're going to do whatever we have to do to make it happen. So, and he was, laid it out, and he's followed every step of the way to get where we've gotten today. The pandemic accelerated things, but I don't think the pandemic necessarily gave us certain things that we wouldn't have had anyway. Certainly, there's a lot of this is transitory, and a lot of this will fade. But prices are not going to go all the way back down to where they were. You're going to have a higher level of general pricing too. So from that perspective, I think this is a great environment for gold, except there seems to be, I don't know, you look at silver, it can't get through $30. Why is that? So many times where it should have broken out and it didn't. So you would think that if the Fed doesn't want their transitory narrative to be challenged, it behooves them to make sure gold doesn't take out $2,000 and silver doesn't take out $30. I think that will happen. I think it's only a matter of time. And I think you can't try and get too cute with this. Is there risk to gold and silver? Absolutely. A policy error here would be potentially devastating to all asset prices.
If the Fed doesn't want it to happen, Greg, how can it happen?
Ultimately, they overpower the Fed anyway. I mean, we go way back. I mean, I know I go a lot further back than you do, but I mean, I go back enough to where, the Plaza Accord in 1985 and trying to control currencies, and it never works. They'll try it until it fails, and then they give up. So, I see a situation now where it's going to come a day where you're going to already want to be long. Like by the day that kind of comes, it's maybe too late. So I think you have to have a core holding now of some crypto, of some silver and some gold, and both. I think it's just a good way to protect, frankly, the purchasing power of your money. It's that simple. It really is.
Greg Weldon of Weldon Financial, thank you so much for joining me here on StansberryInvestor.com. Don't wait another 10 years to come back to see me, okay?
Anytime. Always my pleasure.
And thank you so much for watching. We have a lot more great content for you. You can get exclusive videos and offers by signing up free at DanielaCambone.com. In the meantime, that's it for me. Thanks for watching.